Good morning, everybody. Thanks for joining us on our Zoom call today. We appreciate your attendance with us this morning. Hopefully everything is working correctly. We've had some internet issues today, so if you're having a problem hearing us, seeing us, and whatnot, just put a comment in so we know that it's not working. But hopefully everything's coming through okay and you're able to hear us and see us. We are going to record this as always, and then we'll post it on our website and our YouTube channel, so you can review it later as well and take a look at it. But today's topic is going to be how do we reduce taxes for our beneficiaries? And that's a really broad topic. We can spend lots and lots of time on this topic, on this issue. I decided that I'm going to kind of narrow it down to really focus on three areas within that topic that hopefully gives you some advice and things you can use or at least think about. And so we'll start with that. So to start with, I think it's important that we understand that there's all sorts of different kinds of taxes. A lot of times we just say, how do we reduce taxes? Well, there's different kinds of taxes. We have to keep those taxes all separate in their right bucket, if you will. So we have estate taxes, which is our death tax. So when we die, the IRS wants to know how much stuff we have accumulated during our life, our house, our cars, our checking, our savings, our life insurance, our retirement accounts. And if that pot of stuff is greater than what the IRS thinks we should have, then we owe something called an estate tax, or a death tax is another term that we use for that. And so we're going to talk about that kind of tax and how do we minimize estate tax. We'll spend a little bit of time on that. Another type of tax is income tax, and most of us are used to income taxes. We've been paying income taxes our entire lives. And so we're going to talk about maybe potentially minimizing some income taxes for our beneficiaries when we pass away, and a couple things in regards to that. And then I'm also going to talk about capital gains taxes and some things that we can do to potentially minimize some potential capital gains taxes that we might have. So those are kind of the three things, the three buckets of taxes we're going to talk about today: estate tax, income tax, and capital gains tax. Of course, you also have inheritance tax, you have state estate tax, you have excise tax, you have all these other kinds of generation skipping transfer tax. We're not going to focus so much on those. We're just going to focus on these three today, and hopefully that helps a little bit. So what we're going to do is we're going to share our screen here and use a whiteboard. I think that that's oftentimes helps when we can see things visually as opposed to just hearing it. And once again, hopefully this helps by seeing it. And hopefully everything is coming through okay, and you can hear us and you can see us, and I'm not all like this as you're watching us. And if it is coming out that way, once again, we're going to record this. We'll put it on our YouTube channel and our website, so you can go back and refer to it as often as you would like. So let's first focus on the estate tax, which is the one of the three we're gonna talk about today. So let's first discuss what is the estate tax, what's the estate tax exemption amount, how does estate tax work, and then we'll talk about a couple of things that maybe we can do to help minimize that estate tax. So the estate tax, once again, is just a tax on everything that we have after we die if it exceeds a certain dollar amount. So in 2022, today, our federal estate tax, we're talking about federal, our federal estate tax exemption amount is what we're talking about. Our federal estate tax exemption amount today is $12.06 million per person. So what that means is we can have $12.06 million to our name when we die, assuming we haven't made any gifts over our annual gift tax amount in any given year. We can have this amount to our name and the IRS doesn't care. There's no tax that's paid for estate tax purposes, okay? And anything under 12.06, no tax on that for estate tax purposes. Anything over 12.06, then the IRS says we want our pound of flesh on that. And just to make it super simple, you're paying about 40 cents on the dollar for every dollar over 12.06. So it's a 40% tax rate, basically. So most of us, if we're married, remember, it's per person. So if we're married, we can have over $24 million before we owe $1 of federal estate tax, which means most of us are not going to have a federal estate tax issue. Most of us are going to be under the federal estate. There's somebody else I think that needs it. Most of us are going to be under the federal estate tax exemption amount, which is great, right? And understand that this exemption amount changes as Congress decides what the amount should be. So if you go back to the 1990s, the federal estate tax exemption amount was in the $600,000 amount. And then TARA was passed under President Bush, it went to $1 million, and then it kept going up. And under Obama, it went to $5 million. And then under Trump, it doubled index for inflation to where it is today at 12.06. And so this federal estate tax exemption amount is something you just have to kind of keep your eye on. It's something that can change over time. If Congress does nothing at all with this in regards to the federal estate tax exemption amount, then come January 1st of 2026, this exemption amount will revert back to what it was under Obama, which was $5 million indexed for inflation, which will put us probably somewhere around $6 or a little more than $6 million per person, which is still, if you're married, over $12 million that we can have before we owe $1 of federal estate tax. But just so you understand, this is a number that can change. So if Congress decides, you know what, we gotta start paying off a lot of our debt and taking care of a lot of the bills that we owe, then maybe they drop this exemption amount to a $3 million exemption. And that's where you just have to be aware of that and cautious of that. So how can we minimize a federal estate tax if we're worried about one? Well, number one, most of us are not going to have to worry about a federal estate tax today because it's so high. And more likely than not, even if Congress does nothing and it drops to $5 million index for inflation in 2026, once again, if we're married, we can still have over $12 million before we have a federal estate tax issue. So most of us are not going to have to worry about a federal estate tax. But let's make up a hypothetical situation where we might have a federal estate tax issue. And what are some things we could do to maybe mitigate that federal estate tax? Because at a 40% tax rate, that's a big chunk that can be going to the IRS when we pass away. So let's say that I have a $20 million estate. I'm single. I'm a single man. I have a $20 million estate, which means everything I have, my IRAs, my life insurance, my house, my car, I have a rental property or whatever. You add it all up and it's a $20 million estate with everything I have. And remember, my exemption is 12.06. We're just going to round that off. And it looks like we have another person here. We're going to round that off to just say 12 million. So the difference between my federal estate tax exemption amount of 12, this is my federal estate tax exemption amount, and this is the size of my estate when I die, everything I have. The difference between these two, if my math is right, I know it's still early in the morning, at least will always make sure my math is correct. I think it's $8 million is the difference. And so when I die, this 8 million is what's subject to the 40% tax rate. Well, 40% of $8 million, if I have it right, is 3.2. Is that right, Elisa?
Yeah.
That's what's going to go to our favorite charity, the IRS, when we die. So in this case, and what we're worried about is we're saying, most of us would say, I'm guessing, if you were all here in person, I could ask you all, I would say, how many of you think the federal estate tax exemption amount is going to stay where it is today at 12.06 versus it dropping to something less? whether that's 5 million, 6 million, 3 million, 4 million, whatever. How many of you would bet that the exemption is going to stay here and go up versus going down? And I'm going to bet most of us would say, my bet, Dave, is this exemption is going to drop just because of the amount of expenses that we've incurred with COVID and bailouts and all the stuff that we've been doing. At some point, the piper has to be paid. And so they're going to figure out a way to increase that tax by dropping the exemption. And so if I have a $20 million estate today, and I'm a betting man, and I'm saying to myself, you know what, in 4 years, 5 years, I'm going to bet that this exemption amount is going to drop to a $5 million exemption, right? Then in 2022, I might want to say, you know what, I'm going to give away my entire exemption amount that I'm allowed to give while I'm alive. I'm going to give away $12 million today. I'm going to get it out of my estate. I'm going to give it maybe to an irrevocable trust for my son, Johnny, that he can benefit from. So 12 million of my 20 million goes into this trust for him. That then drops my estate to an $8 million estate. But what it also does, it gets the growth of that 12 million out of my estate. So remember, we don't think this 12 million that I have is just going to sit there stagnant. I'm going to invest it. And so if I kept that in my estate for the next 15, 20, 10 years or whatever, at a rate of return of 10% or whatever I think I'm going to get, then that 12 isn't really 12. When I die, it's worth 15, 18, 20, 25. So I'm not only getting the 12 out of my estate, but I'm getting the growth of that 12 out of my estate. Which then helps, because if the exemption drops to 5, I've got the difference between the exemption today, 12 and 5, $7 million is the difference between those. I've got an extra 7 million out of my estate by using the current exemption amount versus waiting till I die, then I only could get a $5 million exemption. And Congress has said, if you plan on today's exemption amount and using today's number, we're not going to ding you or try to hurt you if the exemption drops 10, 15, 20 years from now. There's no, what they call a clawback is what they said. They're not going to claw this back and include it in your estate if you've already gifted it out based on today's exemption amount that you're trying to use. So that would be a way to minimize this. Now understand that when I die, I already gifted my 12 million out to this trust for my son, Johnny. When I die, I don't get an extra 5 million, right? I've used my entire exemption amount. So whatever I have left, the 8 million is still going to be subject, the 8 million plus the growth, if it grows, right, is still going to be subject to the tax. And you're saying, well, then how did this help you, Dave? Well, had I not gifted the 12 million out today using today's exemption, had I held on to all 20 million until I die and they drop the exemption to 5 million by the time I die, what's 20 minus 5? That's 15 million that I'm over my exemption. 15 million times 40%, what's that, Lisa? 6 million. So what would I rather pay? Or I should say I'm dead. What would I rather my heirs, my kids pay? 3.2 million or 6 million? Well, clearly I'd much rather have them pay 3.2 million. And so that's why we would utilize your current exemption amounts today, getting that chunk out plus its growth. It's close to a $3 million tax difference. So once again, I realize most of us are not having this issue. Most of us are sitting here listening to this and saying, Dave, why are you even going over this? Most of us on the phone or on the Zoom call don't have an estate that exceeds the federal estate tax exemption amount of 12.06 million today, you know, I don't have the luxury of giving away $12 million today. And I understand that, but for some of you that might watch this on YouTube or certainly on our website, we do certainly have clients that have that kind of an estate, 20 million. And in today's environment, we might want to take advantage of this super high exemption amount and utilize it, getting a chunk of it out right now while we have this super high exemption. If we're betting that that exemption is only going to go down in the future. So use it or lose it is kind of the thing. So that would be a way to kind of minimize that estate tax from 3.2 to 6 is the difference there by doing something like this. Hopefully that helped out a little bit on the estate tax side of things. You know, a lot of times the question that's asked is, where do you think the exemption is going to go, Dave? If it's 12.06 today, do you think, what are you hearing? What are your bets? What are you betting it's going to drop to? I honestly don't know. I don't have a crystal ball. If I did, I certainly would not be practicing law. I'd be sitting on the beach somewhere having a great time and predicting the future and whatnot. But everything that my bet, what I think will happen is Congress is going to say, you know what, we're just going to wait until December 31st of 2025, and then this is going to drop anyway to what it was under Obama, what the Democrats wanted, which is 5 million index for inflation. And now it's not an issue that they have to try to get passed or work through in Congress, because it will automatically drop. And that's probably where it'll end up, is somewhere around 6 and some change, which is still a lot for all of us to have before we owe $1 for estate tax. So that's one way to minimize estate taxes. So hope that helped. Next, we're going to talk a little bit about capital gains taxes. Okay, so remember, there's 3 taxes we're going to talk about today. One was estate tax. The other one is income tax, and then capital gains tax. We're going to now just hit on capital gains tax real quick. So capital gains tax, basically how capital gains tax works in a really, simplified explanation or version of it, is if we bought let's use a piece of property. If we bought a piece of property, back in 1970, and we paid $10,000 for that piece of property, this is what the IRS calls your cost basis. Now, I understand there's appreciation, depreciation, all these kinds of things go into improvements and all that, but we're going to just use a simplified version of this to make it easy to understand. But this is what the IRS calls our cost basis, what we paid for it. Let's say in 2022, today, that same property, if we went and got an appraiser to appraise the value of that property, let's say they appraise it for $210,000. So it's really shot through the roof. It's really appreciated. And so the difference, this is what we call our fair market value, what it's worth today. The difference between 10 and 210, which in this case, our math once again, hopefully this is right, Lisa, 200. Difference between these two numbers is 200,000. This is what we call our capital gain. And so if we sell this property, assuming it's a rental property or farmland or vacant lot or something like that, if we sell the property, then we owe a capital gains tax on the $200,000 gain. And basically they just take this, they multiply it times the capital gains tax rate, let's just say 25% with federal and state, and that would be our capital gains tax on that property. The difference between what we paid for, the cost basis, and what we sold it for, the fair market value, is the capital gain. Does that make sense? So hopefully that makes it easy to understand. And so how does this come into, well, how do we save on this capital gains tax? One of the questions we often get is, Dave, I have this lakefront property in Minnesota, and I've had it now, for 30, 40, 50 years. And we've now moved to Arizona, we don't want to continue to pay for the upkeep and the maintenance, and my son lives there and he goes fishing there and he wants the property. And so we live in Arizona now. We have no plans of going back to Minnesota. Should we sell? Can we sell the property, or should we just give the property to our son because he uses it? Why not let him pay for it all? Well, if we sell the property, well, then we're back in this capital gains tax issue, right? That you're going to have to pay the capital gains tax on. Or if we gift the property to our son Johnny, then Johnny takes the property at your cost basis. So he's going to take that property at the 1970 $10,000 cost basis value, which means at some point if Johnny decides to sell it, then he's going to incur the capital gains tax. So one way that you could minimize this effect of capital gains tax, depending on how old you are and what your tolerance is to hold on to the property, you could say, let's say I'm 70, 75, 80, 85 years old, my life expectancy is, I'm right close to my life expectancy, not sure how much longer I'm going to be around, is you hold on to the property until you die. And maybe just make your son pay for the expenses while he's alive and assure him that he will inherit the property when you die. If we hold on to a highly appreciated asset until we pass away, then the cost basis becomes the fair market value. So the IRS basically just says, we don't care what you bought it for in 1970 anymore, Mr. Eastman. Your cost basis is now the fair market value as of date of death. So if I die in 2022, this 210 becomes my cost basis. So it's not what I paid for it anymore in 1970, it's what it's valued at when I died in 2022. So this is my cost basis. Well, if I sell it, I don't sell, I'm dead, but my kids sell it for fair market value of 210. This is fair market value. The difference between 210 and 210, I think this is right, is 0. And 0 times 25%, I think this is still 0. So we've just saved a ton in capital gains tax by holding on to a highly appreciated asset until death occurs. And this would apply to any type of capital asset. So we have a highly appreciated stock, we have a highly appreciated piece of real estate, anything like that that would have that would trigger capital gain tax. If we hold on to it until death occurs under current law, the cost basis would adjust to the fair market value as of date of death, wiping out that capital gains tax, which can save thousands, hundreds of thousands of dollars, depending on how much appreciation we have in the property. So that is one way to minimize some capital gains taxes, is just hold on to the property until death occurs. And then when death does occur, you'll get the cost basis adjustment. You're going to hear some stuff that can get pretty technical with this as well. You'll have some attorneys that will say, let's say this is me over here, and let's say I have the highly appreciated asset in my name that has a $500,000 capital gain stuck in it, and I want to sell it, but I don't want to trigger the capital gains tax. And over here, I have my sweet grandma that I love, and she is 95 years old, but she still has capacity. She still knows what's going on. Then maybe I think, well, if I can get this property to grandma, so she owns the property that has the $500,000 gain, her life expectancy, she's already passed it. She might die in the next couple of years. And when she passes, because she owns this asset, that's included in her estate, which means it wipes out any capital gains tax. And then we have something, an estate plan for grandma, that says, hey, grandma, when you die, this property that I gifted to you so that it could get a cost basis adjustment, this property is going to come back to me upon your death by way of your trust. And so you're getting into kind of this game that's being played right now with attorneys that will say, okay, we have a highly appreciated asset that a 47-year-old owns. He's got a long life expectancy left. And we've got his grandma over here that's gonna be dead probably in the next couple of years. Let's use her death to adjust the cost basis on this highly appreciated asset and then get it back over to the son. So then he gets it at a with zero gain, and then he sells it when it gets back to him, and now he's just saved all that capital gains tax. You'll hear stuff like that that's kind of happening today. This kind of stuff works when we have a super highly appreciated asset that we're trying to save that capital gains tax on. We just have to be careful how we structure it. Certainly, if grandma gets Alzheimer's or dementia and she starts gifting her assets away and doing some crazy stuff, and this asset I gave her might end up with somebody else that we don't want. So we have to be careful with that kind of stuff. But those are some games that are played with the capital gains tax. Hopefully that helped with capital gains. The last tax we're going to talk about is income taxes. So we've talked about estate tax. We've talked a little bit about capital gains taxes. And now we're going to just spend a couple of minutes on income taxes. And how do we minimize income taxes for our beneficiaries when we pass away? Well, the asset that most of us have that's going to have built-in income tax issues are retirement accounts. And so when I say retirement accounts, it means IRAs, 401ks, 403bs, 457 plans. Those are all, I'm just going to lump them into retirement accounts. And I'm going to keep saying IRA, but when I say IRA, I mean all those things, okay? Because it just means trapped income taxes in them. Roth IRAs are different, okay? And Roth IRAs are different in that we've already paid the income tax up front, and now that money is growing income tax free. And when it comes out of the Roth IRA, it's going to come to us income tax free. So I'm going to focus on how we take traditional retirement accounts like traditional IRAs and traditional 401ks and stuff like that, and we move them into a vehicle that's a Roth to potentially save income taxes for our beneficiaries. So that you need to kind of grab onto what I just said and hold on to that, because it's not really minimizing, shouldn't say it that way, but it's not minimizing the income tax for you, because you're going to incur the income tax, but it will definitely save on the income tax for your heirs, your loved ones, your beneficiaries. Okay. So let's say this is me over here. I have $1 million IRA, traditional IRA, trapped income taxes in it at Charles Schwab. Okay. And I want this IRA to go when I die. I want this IRA to, let's say, there's lots of different ways we can go through this. Certainly, if we're married, I could say, let's have it go to my wife. I'm going to say, because the topic for today was to our beneficiaries of our estate. So we're going to talk about kids more today. But so let's say when I set this IRA up, I say, when I die, I want this IRA to go out to my son, Johnny, or whoever. Okay. And if I don't do any other planning, if I just have my traditional IRA intact when I die, and I have Johnny listed as the primary beneficiary of that IRA when I die, then when I die, Johnny doesn't really get $1 million IRA. He doesn't get $1 million inheritance, right? Because the IRS, our favorite charity, is going to say, no, there's trapped income taxes over here that Mr. Eastman never paid. And so when that gets over here to Johnny, that's going to trigger that income tax. And so let's just say that Johnny's income tax rate is at 30%. So if we take 30% off of $1 million, that's $300,000. So I take 1 million minus 300, that goes to the IRS. This is our IRS. That leaves Johnny with 700,000. So you over here, while you were planning, were thinking, oh, I'm going to leave my son $1 million when I die. Well, no, if it's a traditional IRA, we don't do any other planning. Really, he's getting a $700,000 inheritance because the IRS is going to take 30% of it. And most of you would probably say, well, that's fine. Johnny didn't work a day in his life for this money. In fact, he's getting $700,000. I'm fine with that. And then great, fine. Our issue really comes down to what is going to be Johnny's income tax rate when we finally die. And this kind of goes back to what we were talking about with the federal estate tax exemption amount, right? So if we were betting, we're in Vegas, and I said, here's $500,000 worth of chips. And you have to either bet all of these chips that the tax rates are going to go down or they're going to go up. You can only bet those two things, down or up. Where are you putting your $500,000 worth of chips? Then I'm going to bet that most of us would say the tax rates are more likely than not going to go up. They're going to increase. And so in 2022, Johnny's tax rate is 30%. Well, let's say I live another 10, 15, 20, 30 years. And 30 years from now, in 2052, I think that's 30 years, Johnny's tax rate is now 45% or 50% or something crazy. Then, and not only have we should say it differently, then it's not 30% that's coming off of the million. He's now losing 45%, which is now subtracting 450,000 from his inheritance. Okay. And so if we think tax rates are only going to go up in the future, and they're the lowest that they're going to ever be again, then one thing that we could do is say, I'm going to plan under today's income tax bracket rates. And let's say my tax bracket is 20% because let's say I'm retired. I don't have a lot of income coming in. Really, my only income is Social Security and the RMD I have to take from my IRA every year. I'm 75 years old. And so I'm at a 20% tax bracket. And I think by the time I die, Johnny's tax bracket is going to be 30, 35, 40%, which could be 15 to 20% higher than my income tax bracket. So then what maybe I'd want to do is I'd want to convert this to a Roth conversion. Okay, so I convert this traditional into a Roth. Now, when you do a Roth conversion, it's not a Roth contribution. A lot of times people get confused by that. It's not a Roth contribution, it's a Roth conversion. And so all those rules that go with Roth contributions don't apply to the Roth conversions. And so I convert this, and maybe I convert it over time. Maybe I do it over 5 years or over 6 years or 7 years or 3 years or whatever. So I don't pay a ton of income tax because I don't want to pay more income tax than I have to when I convert this, because every dollar I pull out of my $1 million IRA to convert it to a Roth, I have to pay income tax. And so I would meet with my CPA and I would say, hey, CPA, if I take 100,000 out of my $1 million IRA and I convert it to a Roth, will that push me up to the next highest tax bracket of whatever, 23%? So the question is, how much can I pull out before I pushed into the next tax bracket? And your CPA would be able to answer that question. He would say, well, you have a cushion of 50,000, you have a cushion of 100,000, you have a cushion of 200,000 before you're pushed into the next highest tax bracket. And then we stay in that cushion. And so let's say my CPA tells me, Dave, you can absorb $100,000 worth of income before you're pushed up to the next highest income tax bracket. Then I take the 100,000, I convert it into a Roth. I pay income tax on that, but I'm paying it 20%, right? And now that 100,000 is in a Roth. And remember, when it's in a Roth, it grows income tax free. And I make my son, Johnny, the beneficiary of that Roth. And now when I die, that 100,000 goes to him, zero tax, right? Because it's a Roth, so he pays no tax on it. And then if I do that over time, right? If I do that for the next 10 years, then my entire $1 million IRA is converted into a Roth. I've paid at a lower tax bracket rate of 20%. And now when it gets over here, when I die to Johnny, all the income taxes have been paid and it's grown income tax free inside the Roth. And then there's no tax on it to Johnny. And if when I die, his tax bracket is 40%, guess what, IRS? You get none of that in tax from Johnny on the IRA. So you're once again, you're playing this game of, do we think tax rates are going to go up? Do we think that they're going to stay the same? Do we think they're going to go down? My bet is the tax rates are going to go up. And so if you're in one of the lowest income tax brackets right now, and we think those brackets are going to go up by the time you die, on top of the fact that your kid might be still working when you die, so they're going to be paying more income tax because they have more income coming in, then by doing these Roth conversions, we can mitigate some of that income tax to your beneficiary. Now, is this for everybody? No. Should everybody be doing Roth conversions? No. It has to make sense. You have to sit down with your CPA and you have to say, you know, do I have enough, and how much can I absorb into the Roth without triggering more income tax? And we certainly don't want to be paying income tax on the money that we're converting into the Roth. So we want to have some money out here in a savings account, something like that, a brokerage account or something, to pay the income tax on the conversion. Because if you have to keep pulling more money out to pay the tax on the Roth conversion, that's usually not a good idea. But these are things that your financial advisor, your CPA can kind of walk you through and help you decide if it makes sense to do it or to not do it. But the reason I bring this up with income tax is because most of us have retirement accounts. So almost every client that comes in and I meet with, they have some type of a retirement account. And most of those retirement accounts are traditional retirement accounts where we have trapped income taxes in them. And so because it's an asset that most of us have, and because I think we're going to be looking at higher tax brackets in the future, Roth conversions could make a lot of sense in today's environment, today's world. So that is a way to reduce income taxes for your beneficiary. So hopefully that helped. So today, just a summary, we talked real quick about federal estate tax exemptions. We've talked about capital gains tax exemptions. We've now just talked real quick about saving on some income taxes for our beneficiaries by doing Roth conversions. Hopefully that gave you some ideas to think about. We appreciate everybody attending these Zoom calls every month. Hopefully they're beneficial to you and they help you understand things. If you ever want to learn about a certain topic where you're interested in, we're always happy to get some recommendations from you and say, hey, Dave, we would like to learn more about this, or what about this? Just send us those. We'd be happy to do presentations on them to keep you updated on what's happening and give you some ideas. So today we're going to do a drawing for our gift basket. So pull a name out here and see who the lucky winner is today. We'll get our gift basket. We have Bobby. Bobby Otterson. Bobby Otterson, congratulations. You're going to get our gift basket. So we'll have Elisa reach out to you, Bobby, and she'll find a way to get that gift basket to you. Either you can come in or she'll find a way to get it to you.
Thank you.
You're welcome. Thanks for attending today. If there are any questions, feel free to type your question in, or certainly you can just unmute your mic and we can go through questions. If there are no questions, then we will end our Zoom call and say thanks for attending today, and we will see everybody next month. So any questions from anybody on today's topics? We just wait a minute or two if anybody has a slow typer like I am. All right. Well, I think that that pretty much covers it. Thanks again, everybody, for joining us today. Have a great week, and we'll see you next month.